Bismillahirrahmanirrahim. Hi everyone, welcome to my channel. Today in this video, I am going to discuss some another principles of accounting. Okay, let's see here. We already discussed three principles. Now we are going to discuss remaining eight or nine principles. Here is the first principle is full disclosure principle or full disclosure concept, because this principle is also known as concept. According to this concept, there should be complete and understandable reporting on the financial statement of all significant information relating to the economic affairs of the entity. Suppose you have a business, uh, let's say your business name is ABC Private Limited, and at the end of the financial year, you are preparing your financial statement. Financial statement in the sense profit and loss account, trading account, balance sheet, all these things. So this principle of accounting states that whenever you are preparing your financial statement, at that time you have to disclose. Here the term is disclosure. Disclosure in the sense just like open, where you have to disclose all the informations very clearly while you are preparing your financial statement. It means at the time of preparing financial statement, you need not to hide any information related to the economic affairs or entity of the business. Now, the thing is that what type of information we should hide. Suppose your company is producing uh, medicine, and your medicine is very popular into the market. So, you should not disclose the formula or the chemical reactions, whatever you are doing there. You should not disclose all the things. But if ABC Limited having any loan amount, it should be mentioned in the financial statement. Having any development plan, then it should also be mentioned. So the full disclosure principle concept states that no any information should be hide or should be hidden. Now the another concept is materiality principle. Materiality principle is the extensive form of or extension of this full disclosure principle. Here we are studying that there should not be hide any information. Any information means all those information which are very significant for the business users. Here materiality principle says that according to this concept, all the material or items should be reported properly in the balance financial statement. Items are considered as those items whose inclusion or exclusion results in significant change in the decision making of the users of the business information. It means here what we have to do, that all those items which are materials we have to mention into the financial statement. Suppose when you prepare the profit and loss account, you have different type of rent. Suppose you have building rent, you have vehicle rent, you have equipment rent, like this. Then this principle says that all these rents you need not to mention separately. What you have to do, you have to do make a head here rent. Suppose you have business or house rent 10,000, and this vehicle rent you have paid 5,000, like this, and this rent you have paid 2,000. Then you need not to show all these heads. You just show the total amount. How much? 10 plus 5 plus 2, 17,000 single head. It means these are rent, these are the materials, and house rent, vehicle rent, equipment rent, these are the immaterial. So immaterial item should not be mentioned. Materiality concept says that here the material item should be reported properly in the financial statement. Concept is clear now. What is the difference between full disclosure and materiality concept? Full disclosure means all types of information, all those information which are significant, it should be um, disclosed into the books of account. And here the materiality principle means only the material items should be reported properly into the financial statement. Now come to the another concept, the prudence or conservative principle. This accounting concept promotes prudence in accounting. Prudence in the sense it states that profit should not be included until it is realized. However, losses, even those not realized but with the remote possibility of occurring, should be included in the financial statement. Suppose you are preparing the financial statement or balance sheet of your firm. You have no any chances of mm, creating liability, but in future it may be. So you you have to write here or create here a liability which is known as contingent liability, and you have to keep the amount of rupees 1000, 2000, like this. It means this principle shows that if there is any chance of profit, it should not be recorded until it is realized. Means whenever until you get this profit, and if there is any chance of loss, whether it is realized or not, it should be mentioned into the financial statement. Means in simple way we can say that any type of anticipated loss should be shown in the financial statement. This is the concept of prudence or conservative principle. Now come to the another concept, cost concept. Here is the cost concept or historical cost concept. What is the cost concept or historical cost concept? Concept is also known as historical cost concept. What does it says? According to this concept, it states that all assets of the firm are entered into the books of account at their purchase price. Purchase price is, what is the purchase price? Suppose you are purchasing a machinery, the value of machine is 1,50,000, and you are paying transportation expense. How much? Suppose 10,000 you are paying the transportation expense, and now you are paying installation charges. How much? You are paying, suppose 5,000 installation charges. Now how you will calculate the value of machine? What will be the value of machine? The value of machinery will be calculated with the total amount, 1,50,000 plus 10,000 plus 5,000. It means total value will be 1,65,000. So the value of machinery is 1,65,000. It means you have purchased this machine. How much price? 1,65,000. So this principle or cost concept or historical cost concept principle says that whatever the purchase value of the machinery or whatever the purchase value of the asset, it should be written into the books of account, not the 1,50,000 we will retain into the books of account, but we will retain to the books of account 1,65,000. So this concept, cost concept or historical cost concept, says like this. In the subsequent year too, the price remains the same minus depreciation charge. The market price of the asset is not taken into consideration. Suppose you have used this machine, after an year, the value of machine will be depreciated, maybe rupees 10,000 or maybe 5,000. But here, according to this concept, you have to write the cost, how much you are getting this machine. So this concept is known as historical cost concept or cost concept. Now see here the matching concept. What is the matching concept? This concept states that the revenue and the expense of a transaction should be included in the same accounting period So to determine the income of the profit, all the revenue and expenses, whether paid or not, must be included. It means the revenue and expense should be matched in a particular year. In a particular year, in the sense how it should be matched. Suppose we have to find the profit, then how you will find the profit? Revenue minus expense. Whatever you have, uh, get revenue, and what is your expense, from this you can be able to find profit. So this concept says that the revenue and expense should be matched. This is the matching concept, whether it is paid or not paid, but it should be included. The matching accounting concept follows the realization concept. Realization concept in the sense whether it is realized or not realized. If it is recognized, then it should be written into the particular financial year. So this is the matching concept. Now the dual aspect concept. Is very simple. As you know that accounts having two aspects, we are studying dual entry book system. So here are two aspects. First one is debit and second one is credit. So according to this concept, the basic principle of accounting is the heart and soul. It is basically one of the golden rules of accounting. For every credit, there must be corresponding to debit. So every transaction we record must have twofold effect. It will be recorded in two places. This is core concept of the double entry accounting system. Double entry means every transaction must having, if there is credit, then must having debit. If there is debit, then must having credit. This is the double aspect concept. Now come to the next concept, which is a realization concept or a revenue or recognition concept. What does realization or revenue recognition concept states? According to this concept, revenue is only recognized when it is realized. Now, the revenue in cash inflow of a business for a business arising for the sale of goods or services, and we assume this revenue as realized only when it is legally arises to be received. In this way, what does this realization concept says? A businessman sold goods on 1st April 2024. He is selling goods of rupees 5,000, but still he has not received the payment because he is selling the goods on credit. So the revenue recognition concept says that whatever the revenue related to this financial year, and it has been realized or not realized, it has been received or not received, but arised, then it should be recorded into the books of account of this particular financial year. This is the concept of revenue recognition concept. Suppose at the end of this year, 31st March 2024, you are paying a rent of rupees 500, or you are not paying, you have outstanding amount of rent rupees 500 of this financial year. Then according to this concept, you have to show this rent amount into this financial year, not the another financial year. So the revenue recognition concept says that when it is realized, it should be entered, whether it is paid or not paid, whether it is received or not received. Now see the last concept of this accounting principle, verifiable objective concept. Transaction is recorded on the basis of evidence. As I discussed earlier, that we cannot record the transaction without any evidence. And what will be the evidence? Evidence will be the form of any voucher, any document, pay in slip, like this. This concept states the obvious assumption that the accounting transaction recorded should be objective. free from any bias. Time of recording any transaction, you must have few vouchers, bills, letters, challans, certificate, invoices, etc. So verifiable objective concept says that without evidence we cannot record any transaction. So these were the uh, principles of accounting.